SEC's crypto crackdown, a deep dive. Let's start with the big news that's rocking the crypto world. The SEC has just unveiled its most aggressive regulatory initiative targeting digital assets to date. This isn't just a memo or a subtle policy tweak, it's a full-blown strategy with teeth, and it's already causing ripple effects across the market. So what exactly happened? The SEC, under Chair Gary Gensler, is rolling out a comprehensive crackdown that touches nearly every corner of the crypto ecosystem: exchanges, staking services, stablecoins, DeFi protocols, and even NFT projects. This effort marks a shift from sporadic enforcement to systematic regulation, and it's already started. But why now? Why the sudden pressure? Well, this has been brewing for a while. Gensler has consistently argued that most tokens on the market are unregistered securities. His position is grounded in the Howey test, a 1946 Supreme Court case that defines an investment contract. Essentially, if you invest money in a common enterprise with the expectation of profit from the efforts of others, it's a security. Most crypto tokens? Check all those boxes. In recent months, we've seen the SEC file lawsuits against Coinbase and Binance. These aren't small-time companies. They're the biggest crypto exchanges in the US and globally. The lawsuits allege they offered and traded tokens the SEC considers securities without registering with the agency. This move alone signaled that no company is too big to escape scrutiny. What does the SEC want? It wants exchanges to register. It wants staking platforms to either register or shut down. It wants transparency, investor protection, and a system that mirrors traditional finance. Whether or not you agree with their approach, it's clear the SEC is playing for keeps. Now, let's talk about the implications, because this goes far beyond lawsuits. Crypto markets reacted instantly. Within 24 hours of the Coinbase and Binance lawsuits, billions were wiped from crypto's total market cap. Investors started rotating out of altcoins and into Bitcoin, which is notably the only token both the SEC and CFTC agree is a commodity, not a security. That's right, Bitcoin is the golden child right now. Everything else? Regulatory gray zone. Some tokens saw sharp declines: ADA, SOL, MATIC, all labeled as securities by the SEC in recent filings, dropped double digits in days. Exchanges like Robinhood delisted certain tokens to reduce exposure. And investors? They're nervous. Rightfully so. So what does this mean for the future of crypto? Here's the big picture: regulation was inevitable. But the way it's arriving, aggressively, through litigation instead of legislation, has sparked debate. Critics argue that the SEC is stifling innovation and driving businesses offshore. Proponents say it's about time crypto was held to the same standards as traditional securities. And here's a key point most people miss: regulation isn't necessarily bad for crypto. In fact, clear rules could bring in institutional investors who've been sitting on the sidelines. But how those rules are created, and whether they support innovation or crush it, is what matters. Now that the SEC has fired its shots, what happens next? And more importantly, who's at the greatest risk? Let's start with staking. The SEC has made it clear that staking as a service, offered by exchanges like Coinbase, Kraken, and others, could be considered an unregistered security. Why? Because investors are handing over crypto assets in exchange for returns, which looks a lot like an interest-bearing investment. Kraken was hit first. The SEC fined them $30 million and forced them to shut down their staking program, and the US Coinbase staking product is now under the microscope. And more could follow. This crackdown could ripple through the Ethereum ecosystem. Ever since Ethereum transitioned from proof of work to proof of stake, staking has become central to its security and functionality. If regulators classify ETH staking as a security activity, US exchanges may be forced to disable it. That could lower network participation and impact Ethereum's decentralization. Now let's talk DeFi, decentralized finance. This is where things get tricky. DeFi protocols don't have CEOs. They don't have centralized offices. But they often have core teams, token allocations, roadmaps, and governance structures that mirror startups. If a protocol's token is promoted with expectations of future profits, and let's be honest, most are, the SEC might come knocking. Take Uniswap. It's arguably the face of DeFi. Its token, Uni, could face scrutiny. Same goes for Aave, Compound, Synthetix, any protocol with a clear team and token economics. The SEC has hinted that decentralization theater, where a project claims to be decentralized but really isn't, won't be tolerated. NFTs? Believe it or not, they're also on the radar. If an NFT project sells digital assets and suggests they'll go up in value, or gives holders access to revenue sharing or future profits, that may qualify as a security. In fact, the SEC has already launched probes into several high-profile NFT collections. The days of just art may be over. What about stablecoins? Well, they're getting their own kind of attention, especially algorithmic ones like Terra's UST, which famously collapsed. Regulators want to ensure that stablecoins are fully backed, auditable, and not posing systemic risks. The SEC hasn't declared all stablecoins securities yet, but they are working with other agencies to set guardrails. So who stands to benefit? Ironically, Bitcoin. It remains largely untouched by these actions. Its decentralized nature, lack of an issuing entity, and recognition as a commodity make it a safer bet, at least in regulatory terms. Ethereum is more complicated. Some regulators believe ETH is a security post-merge. Others disagree. Until Congress passes a law clarifying this, we're in limbo. Projects with strong decentralization, transparent governance, and regulatory compliance strategies may attract more capital moving forward. Think of protocols like Chainlink, which provides data infrastructure, or layer 2s like Arbitrum and Optimism that focus on scaling rather than tokenomics height. Let's zoom out and look at the bigger picture now, because this crackdown isn't just about individual projects or exchanges. It's a signal to institutions, investors, and lawmakers that the US is drawing hard lines around crypto. So how are key players responding? Let's start with the institutions. Despite all the noise, traditional financial institutions are still inching into the crypto space. BlackRock filed for a Bitcoin spot ETF. Fidelity is offering crypto to its clients. Even JP Morgan, once a vocal crypto critic, has been using blockchain for cross-border payments to its JP Morgan coin. Why? Because demand is still there. But institutions want clarity. They want to know they won't get sued for offering access to assets that might later be deemed securities. So while the SEC's aggressive stance is scaring some companies off, others are simply waiting on the sidelines for clearer rules. Now, the legislative angle. Here's the problem. The US doesn't have a comprehensive federal crypto law. Instead, regulators like the SEC and CFTC are left to interpret old laws from the 1930s to fit 21st century technology. That's like trying to regulate Uber with horse and buggy rules. Lawmakers in Congress have proposed multiple bills. Some aim to define which agencies oversee what. Others aim to create a new framework altogether. But so far, there's been little progress. Partisan divides and a lack of urgency have slowed everything down. That's why the SEC has taken matters into its own hands. This regulatory by-enforcement model has upset many in the industry, not because they don't want rules, but because they don't know what those rules are. Companies are asking for clarity. The SEC's response? Register. But many say there's no clear path to do so. Globally, things look very different. The EU recently passed MiCA, a sweeping crypto regulation that lays out clear rules for stablecoins, exchanges, and custodians. It's being praised as a balanced approach that protects investors without crushing innovation. Singapore and the UAE are also attracting crypto firms with progressive but clear frameworks. In contrast, the US is watching companies and jobs move offshore. So what does all this mean for the average investor? In the short term, expect volatility. Regulatory headlines will drive price swings. Tokens named in lawsuits may see drawdowns. But long term, the winners will be projects that are transparent, decentralized, and adaptable to new rules. Here's how to protect yourself. Stick with major assets that have clear legal standing, Bitcoin and possibly Ethereum. Be cautious of new tokens without clear use cases or roadmaps. Follow news from both regulators and lawmakers. Diversify, not just within crypto, but across asset classes. Bottom line, regulation is coming. That's a good thing if done right. The goal is to protect investors and create a sustainable market. But the path there will be bumpy. This crackdown is the start of a new chapter, one where crypto matures, institutions get involved, and the Wild West starts to look more like Wall Street. Stay sharp, stay informed, and stay adaptive.